Friends, welcome to the monthly outlook on markets. This month, we intend to cover three important aspects. First, global geopolitical and macroeconomic issues that have risen recently. Second, US 10-year Treasury yield that reached 5%. And third, earnings so far with an eye on few IT sector companies that have reported their results. Friends, month of October was bogged down by multiple headwinds globally as the world witnessed the emergence of yet another conflict arising out of Middle East. Post the negative impacts ravaging the world economies due to the ongoing war between Russia and Ukraine, a start of another conflict can have a contagion effect. Amidst these escalating geopolitical tensions, IMF released the revised expected growth rates in its October 23 World Economic Outlook. Major highlights include India's growth forecast for 2023 was increased marginally by 20 basis points to 6.3%. US growth forecast for 2023 was increased by 30 basis points to 2.1%. Growth forecast for China and EU was revised downwards. Overall, for the world, the growth forecast for 2023 was kept constant at 3.0%. Marginal upward revision of India's growth rate was based on growth of manufacturing and consumption that we saw in the last 9 months of this year, along with strong expectation from this festive season. Currently, festive season has started off well. Online sales have bounced very strongly. However, one need to take the global forecast of IMF with a pinch of salt, as these are based on views prior to the outbreak of Israel-Palestinian war, which has increased the global risk. The contagion effect of the war, if it persists, may spill over past the Middle East region, and the intensity will increase if other countries join the conflict. As a fallout of this, inflation may remain high and sticky. The record debt levels globally, clubbed with high interest rate, puts the global government's borrowing cost and capability in limelight. Post a minor drop in global debt levels in 2022, it has started to rise again in 2023, and most of the increment came from developed countries. The question is not in relation to the repayment of huge debts accumulated by these developed nations, but the effect on fiscal policies that they would be forced to undertake to fund these debts. With interest rates at elevated level, fiscal deficit of these nations will be under stress. The spillover effect of that on all the economies around the world will unfold over time. On the other hand, developing nations like India are in a better position with comparatively much lesser external debt, which brings a lot more stability for them as developed economies face uncertainty. In terms of inflation as well, India is very well poised compared to their developed counterparts who are struggling to get it within tolerable limits. An important event during the month was the rapid ascent of the US Treasury, and this has unsettled investors globally. The benchmark 10-year yields have surged from 3.3% in April 23 to around 5% now. This is the highest level since the financial crisis in 2007. This sharp rise has been mirrored at the shorter end of the yield curve as well, with 3-month Treasury bill yield crossing the 5.3% mark and 2-year yield surging to 5.2% from calendar year 23 low of 3.75%, as US Treasury bill issuances remain very elevated. The surge in US Treasury yields has sparked anxiety among investors in recent days, raising worries about persistence of tight financial conditions. One of the key factors that led to the surge in US rates in 2023 is the hawkish stance of Fed amid the tight labor conditions and relatively resilient economy. Fed has consistently upgraded its assessment of US growth, as well as guidance on Fed fund rate for this year, and this has led to the repricing of US bond market. Another aspect that has kept pressure on the bond market is the demand-supply dynamics and US government's fiscal health and operational headwinds. Gross issuances of treasury bills rose by 40% year on year to $13 trillion in last 9 months, This gush of bills supplies has also kept pressure on yields persistent. The spike in rates has led to tightening of financial conditions by making new debt much more expensive. This should eventually raise the cost of existing debt as fixed terms run out on loans to businesses and households. This would weigh on investments, real GDP growth, and eventually inflation driving yields lower. This, however, would take a while. The primary impact on the Indian markets due to rising US 10-year yields can be seen through flows and pressure on the currency. The persistent pressure on the currency amidst the narrowing spread of India yield and US yield compelled RBI to recently inch up the bond yields through announcement of likely bond sales under open market operations. India 10-year yield rose to 7.4% versus current year low of 6.9% that we saw in May 2023. However, the delta rise in yield in India has been comparatively lower than that of US Treasury, and for that matter versus many other parts of the world as well. Also on the currency front, Indian currency has been relatively very stable this calendar year and has seen lower depreciation versus other major currencies. With the global uncertainties, FPI flows in equity markets in India turned negative in September with net FPI outflows of $1.77 billion in September 23. This was the first outflow since Feb 23. Sell-off continued in October 2 with net FPI outflows of almost $1.1 billion. Yet, this financial year, India has been one of the few nations with net FPI inflows. Most of the other major economies have been witnessing huge drawdowns from foreign investors this year. While macroeconomic factors like US yields and geopolitical tensions have a broad impact on markets, it's also important to look at some specific trends that are shaping the investment landscape. One such sector warranting close attention is the Indian IT sector, which we believe is currently navigating a transitional phase characterized by both challenges and opportunities. In our assessment of IT companies that have posted their quarterly results, we observe an interesting dichotomy between slowing top-line growth and a very robust order inflow. On one hand, companies are increasingly reporting higher deal wins led by longer-term deals that are more cost-focused, signaling a strategic shift from their emphasis on digital transformation projects. On the other hand, the increased scrutiny of earlier deals has led to revenue leakage, which are raising concerns about both the quality of earnings and operational efficiency. The changed character of the deal wins imply an increased execution period. This would mean a sustained but a low rate of growth in the foreseeable future. Also, IT companies during the quarter have had a slow or reduced hiring, pointing to slow ramp up of the deal wins. Other companies that have declared results so far are from private sector banks, NBFCs, consumers and autos. Most of the results declared so far have been in line except auto, which once again is standing out with a solid margin expansion. Staples continue to report slow but stable revenue and profit growth. Thank you. Happy investing.